All right, so without further ado, let's get started. For today, we'll dive into risk management in DeFi, particularly in lending protocols. I'll start by covering a bit of an overview of the space and the risks pertaining DeFi. So just to get everyone up to speed on some of the key terms and functionality so that we can understand. Then I'll dive more into economic risk management, why it's important, and then how you can look at it with regards to lending protocols in particular, but also to understand the relationships between multiple protocols and how they work with one another at the same time. And finally, some best practices to keep in mind for those looking to use DeFi, and sort of the next steps on how DeFi risk management is evolving. First, though, let's go through a quick update about Into the Block. I guess the key update here is very relevant for today's presentation is our alpha release of what we're calling the Risk Radar, Into the Block Risk Radar. If you haven't checked it out, make sure to do so. It's available in our Medium page if you can find it. Also, I believe the URL is defirisk.intotoblock.com. Maybe someone from our team can share it. Yeah, thanks, guys. I'll be covering some of these metrics throughout the presentation, but if you haven't, make sure to check it out. And in terms of partnerships, we launched with the crypto app and a few other partnerships are ongoing. So DeFi is complex. I think most of us know this, but it's good to just emphasize it and start there. It's very important to do your own research, as cliche as it's become. It's important to understand who's behind a protocol, what are the actors within it, what are the dynamics in general between those supplying liquidity, for instance, and those that are borrowing or trading. If there's yield and you're looking to get yield, it's important to know what are the sources of the yield to understand, one, how sustainable it is, and if there are any risks that you can get from it. One good quote that I like to point out, I don't know who came up with it. I couldn't find it online, but if you don't understand the source of yield, you are the yield. I think in DeFi this can often be the case, as it's a bit unclear for some of the more newbie people that provide liquidity looking for things, and oftentimes they can be stuck in a pool afterwards if it's something like very liquid or very risky. So it's worth keeping those dynamics in mind and what they entail. Also, it's good to take everything with a grain of salt, even though in the documentation pages of some of these protocols, they can outline like how mathematically it can work. Oftentimes in practice, it doesn't. Perfect example of this is Terra, which they believed would work in practice, but would work in theory, but in practice, as people panicked, didn't really make it out. DeFi is DeFi is open, of course. So 99%, or at least the true DeFi protocols, are open sourced, so you can review the whole code. But even though this is nice because anyone can use these protocols and review them, it also creates the opportunity to be adversarial, because people can review the code and find some loopholes to extract capital or even to exploit them economically. So there's this adversarial nature that people should consider, which over time should make the protocols more resilient. But as we're still in the embryonic phase of DeFi, this adversarial nature can often be difficult and lead to losses for people. And I've kind of been alluding to this, but the risks within decentralized finance are very different from those in traditional finance, where solvency can often be measured differently. A lot of the protocols here are over collateralized as opposed to fractionally reserved in banks in this case. Both models, of course, have their own issues, as we're seeing with the past couple of rocky weeks in banks in the traditional world, but they're very different. So it's worth understanding some of these intricacies with DeFi. So I would classify risks within two different spectrums in DeFi. One is if they're economic, meaning that there are some factors and financial incentives that can lead to risks to the protocol. And the second type is that they're technical, which essentially means within the code, there is something that can be exploited, can be kind of like a loophole or an unintended consequence of the way how that is written that can lead to losses. Sometimes it's even a mix of the two, which make it a bit more complex for some of the attacks. And then it can be internal risk, as it can be like regarding those that deploy the code and if they have any access for them to withdraw capital, and that can be, stolen by someone, or it can even be used to deliberately steal money, or external, which is in most of the cases, an external party, a hacker or an economic attacker looking to withdraw funds in a certain way. And based on that, given my meme skills, I would classify economic attacks as, of course, economic in nature, but also external hacks as technical and external, and rug pulls as technical and internal, usually. So some examples, I think, help for everyone to understand these. So in terms of smart contract risk, a good example would be the DAO hack, which led to the creation of Ethereum Classic back in 2015. There was what was called a re-entrancy attack, which effectively allowed someone to run a code twice to withdraw more capital than they should have been able to. So going back to like unintended uses of code, re-entrancy attacks are a good example of that. And there's more complex types of smart contract exploits, such as those that Poly Network and Wormhole went through, that led to almost $1 billion loss in between those two. Then there's key management, and so this is kind of internal risk, as I was mentioning, since oftentimes people deploying the code have access to funds. So if it's not protected correctly or don't have the right methods in place to avoid withdrawals from those code deployers, it can lead to losses. Perfect example here is how Ronin Network from Axie Infinity, their L2, or their L1 rather, their bridge, how it lost 620 million. I think it was to the Lazarus group. I know for a fact that was the case with Harmony Bridge. I think also for the Ronin Network. So effectively, the government of North Korea got access to the keys operated by these deployers of the code and was able to extract the capital. So that's why key management is very important and a technical risk to keep in mind. And finally, it's a bit more less common, but there can also be front-end hacks where in the UI, it overlays like a hidden button, or instead of being redirected in your MetaMask to send capital to one address, it instead redirects it to another one. These are less common. Curve had a smaller attack like that of about 500,000. Badger DAO had a larger one where it was a bit more complex. I won't get into the gist of it, but these are also worth keeping in mind. Then diving into economic risk, we would classify those between supply and demand side first and foremost. And these are also interconnected. So a lot of times you'll see them playing with one another, these risks. So on the supply side, a perfect example is Terra, that had the unsustainable, price minting and burning, that led to hyperinflation once it depegged. Impermanent losses are also definitely a risk for those providing liquidity to protocols. That is very hard to quantify how much it's in total. I would estimate at least in the hundreds of millions, if not billions. And this is more a risk for the individual than the protocol, but it's worth pointing out nonetheless. And something like Mango, which we suffer Oracle manipulation attack. It was part of between manipulating the supply and also the Oracle that was used to calculate the price for an asset. I'll talk on these a bit more later. On the demand side, liquidations are also an important risk for lending protocols for users to keep in mind, because essentially if you take too much leverage against your collateral and your collateral drops, you would realize losses. And on the protocol side, this could often lead to bad debt if it ends up being unprofitable to liquidate those positions. I'll touch on that later. Then stability actors we define as a lot of these external parties that help balance the protocols. So oracles are a key part for lending protocols. Arbitrageurs, for instance, also add a lot of value to DEXs, helping, for instance, keeping pegs maintained and markets efficient. And there's also intrinsic asset risks to keep in mind, especially when assets don't operate in the most normal ways. UST, again, a good example there. Cream was exploited due to a token that is supported that wasn't like an ERC20, was a different type of token, and had some issues that led to an exploit. And more recently with USDC, of course, we're seeing a different take on intrinsic risk asset, as the assets stored by Circle in banks, expose them to all of this bank run that Silicon Valley Bank and other regional banks are now going through. And then finally, the case of governance is another factor to consider. Beanstalk is kind of an obscure stablecoin project, got exploited for 181 million as someone borrowed like a large chunk of their Beanstalk token, manipulated a governance proposal on their favor, executed it, and effectively withdrew clients' funds without their consent. And now I touched on the basis of this, but let's talk about why economic risk management is important. First thing is it can be mitigated. So even though it can still lead to catastrophic scenarios, economic risk typically takes weeks, sometimes a bit less, sometimes a bit more, for those risks to materialize, versus economic versus technical attacks, which typically, boom, it's gone within just a block or a few minutes at most. So this is an example on the left is the Mango hack, where within a few minutes, I think within a block even, all of the funds were stolen. So that really you can't do anything about it at that time. Versus the UST peg, which is the largest economic risk event to have happened publicly. It did crash quite quickly, but if we look at these both within a 2-week time frame, you had some time to be able to exit. This is the anchor TVL. So you had some time to be able to take actions, to be able to mitigate your losses if those are materializing. Another reason why to focus on these is that they're potentially even larger. So this was briefly after the Terra exploit, economic attack. And it's of course skewed since this is by far the largest, but it doesn't include impermanent losses. So it's hard to estimate all in all, but they would be theoretically at least about the same, excluding Terra. Including things like Terra, it's by far economic risks are way larger. And third, they're easier to understand. I imagine not many within our attendees for the webinar know Solidity, and if they know, typically it's the basics, not the hardcore programming experts. So even though if it's open source, it's very hard to interpret if you're not an expert. Versus, a lot of the economic risks are transparent, just as transparent as the code, but they're more understandable for people who know basic finance and math. We're also from Into the Block, we're also trying to help educate people about these risks, and it's an effort. Of course, people don't know fully about all of them, but we hope with this webinar, as well as with the Risk Radar launch, to create more clarity in how to measure these risks and how to mitigate them, of course. Now, diving into lending protocols, there are risks in different levels. So on the user level, and the market, and the protocol. Starting from the top, users, the main risk is getting liquidated in a lending protocol. So Aave came up with this metric called the health factor, which effectively means how close you are to being liquidated. It's calculated by showing the maximum amount you can, the amount you borrow versus the maximum amount you can borrow. If that amount is below 1, it essentially means you've borrowed more than you can, and therefore your collateral is liquidated and you lose part of it. And if not, your position is healthy and you can still be fine without risking anything. Because it's all automated, for better or worse, you can't convince the protocol to not liquidate you. And we've seen with things like FTX collapse that it actually helps, people prioritize these debts more than centralized debt, where you can potentially persuade them and oftentimes manipulate them in ways like 3 Arrows did. So that's the main risk on the protocol level, on the user level. If we move it one step ahead, there are risks for the protocol as well as for the market. I think I skipped a slide. So between the lending protocol, between the user and the protocol, there are market risks. So just to cover these quickly, essentially, if there are liquidations, the liquidators sell your asset, your collateral asset, to repay your loan, and they take a bonus, to incentivize the protocol being balanced. And that liquidation process can often lead to prices to decay even more, in what's known as cascading liquidations. So in times of in times of volatile markets, it can exacerbate the volatility, as liquidations can put pressure on markets in general. Then on the protocol level, there's the risk of bad debt. And this is a term that gets thrown around a lot, and I don't think it's properly defined. The easiest way to understand it is effectively credit that can't be repaid to those depositors. And it's funny, but we're seeing parallels in traditional finance on this these days. But pertaining to DeFi protocols, essentially those supplying liquidity, their liquidity is being borrowed, at least part of it, by borrowers, and those borrowers provide collateral as well themselves, and that collateral can be taken to repay their debt in case that their assets get imbalanced. But what happens when suddenly you can't repay their loan because it's no longer profitable for a liquidator to rebalance that debt according to their assets and liabilities? When that occurs, effectively there's a debt that can't be repaid to the depositors, and it hurts all the depositors of the pool equally, typically, and it leads the protocol with bad debt that it can't repay. So it's a bad circumstance for everyone at that point. Some examples of this are exploits that Venus Finance in BNB chain had. And at one point back in 2020, Compat also had a similar exploit. And that's why it's important to know when you're supplying liquidity, people borrowing, how solvent are they? And through these indicators, we try to depict that relationship. So it's important to see what collateral is being supplied from the borrowers to borrow your assets. So I think this is for the USDC pool in Banky. So you can see here that there's a lot of AVAX, staked AVAX tokens borrowing USDC, and there's also some people apparently borrowing USDC against their USDC. So based on that, you can also simulate how profitable it is for those loans to be liquidated in case that they were to be liquidated. And if they're not profitable, well, then you have a problem, because there might not be the economic incentives for a liquidator to step in and mitigate that risk of bad debt by rebalancing. So here in this case, we see liquidations are profitable all around. I think with SAVAX, it might not be super profitable after a 1.5 health factor. So that's the x-axis, the health factor. So as more amount gets liquidated, the profitability decreases. But nonetheless, in this case, it's still profitable. So it's not a systemic risk in general. And you might be, by now, understanding that lending protocols don't work in a silo themselves, like excluded from the broader DeFi economy. There's a lot of interdependence within DeFi. And a good example of this is, you can't liquidate positions in lending protocols if there's not liquidity in DEX protocols. So as I was just showing the slide before, it would be unprofitable if there wouldn't be liquidity. So a good example would be with like USDC, just pegging over the weekend, the 3 pool, which is the most liquid pool for USDC, USDT, and DAI, saw a large amount of withdrawals, so about 200 million getting withdrawn during the weekend, very sharply. So at that moment, liquidation started being less profitable, and the pool became more imbalanced, which meant that people were withdrawing USDT first and then DAI, and the pool was primarily USDC, which also means that there's more slippage if you want to trade, like sell USDC for USDT. So it led to some worrying concerns there over the weekend that fortunately didn't materialize, but shows just how reliant the lending protocols were on DEXs and their liquidity. And the liquidity that itself relies on stability. There's no one wants to provide liquidity if they can't, if they think that the tokens in the pool will go to zero, then of course people will withdraw. And it also need a financial incentive to provide liquidity, which sometimes can be the liquidations themselves. So there's a bit of an interdependent connection there. That's worth keeping in mind how all of these market forces come together. All right, now let's dive into some best practices, some actionable steps that you can take. I wouldn't consider this, and this is not financial advice. It's more just things to keep in mind to help safeguard people's assets if they are looking to use DeFi. At the individual level, first and foremost, it's important to have multiple wallets, because when you give a protocol access to your funds, they can access a lot of times by default all of the assets like within that token. They can access all your funds within that token. So if you supply ETH to Curve and you don't select like a limit, which is by default is they can access all, and then you use 100 more protocols, and a shady protocol you gave access to your funds as well, they can withdraw all of your ETH regardless. So it's good that's why it's typically for riskier protocols. I would suggest using like a separate wallet. It costs nothing to create a new wallet, so it's a good practice to create a lot of different wallets. Potentially per protocol might be too much, but it doesn't cost anything, so it could be a good practice. There's also a risk with holding your own custody is that you lose access to those funds. You forget your password, or you didn't write down your keys properly. So there's this social recovery mechanism that's been getting traction recently. There are some wallets that allow you to do this, where effectively when you create the wallet, you give access to, I don't know, 3-4 of your best friends, and you need more than half of them to be able to say like, hey, effectively this guy lost access to their funds, and together they agree to input a transaction that will provide you your keys to access those funds again. That's one technology that's still like nascent, but it's getting more adopted. I think some wallets like Argent already support it. Do extensive due diligence. Sometimes it's not the sexiest thing to do, but if you're looking to earn yield on your capital, it's definitely worth considering the risks, and that's where due diligence comes in. Avoid high concentration, and I mean that in 2 ways. So also, you don't want to be in a pool where one whale owns 99% of the pool, because if they withdraw their capital, there are some consequences to that. But also, don't put all your assets within one protocol, because if that protocol gets affected, then you lose all your funds. Of course, we don't want that to happen. You can hedge positions, and that's why it's important to understand the dynamics at play, to understand what would be the best way to hedge, and have an exit plan in case things go wrong. For companies, I would suggest multi-sig wallets. These have been around for a few years now, and that's the best standard to have multiple people validate transactions, because a lot of times people can hack like your laptop, and if you don't have proper security and they hack your laptop, they can potentially steal your funds if you don't have proper key management. But it's harder, it's less likely that they hack all of your organization's laptops. Also, of course, if you use like a cold wallet, this would make it even like a ledger, it would make it even more improbable. Some organizations, if they can afford it, it would be worth auditing the protocols themselves or the strategies that they use, understand other depositors within the pool. You can look at these like through Etherscan, for instance. And if you can, set up some risk alerts. These are actually one of the benefits that we're trying to put forth with our risk radar is an API for users to be able to set alerts in case there are some parameters indicating risks. For protocols, it's also important for them to use multi-sig wallets, potentially even more than one set, depending on like the functionality, and have not just internal people within these, but also some like highly knowledgeable people, external parties involved, that helps make the process more sturdy and less likely to be compromised, all minimizing the risk of a central point of failure. It's important to audit every single line of code. It hurts when a protocol gets exploited and they've been audited, but they like make one change that didn't get audited and they exploited because of that. It unfortunately does happen, so it's worth auditing the protocol after every single line of code that gets changed. It can be costly, that's the issue, but at the end of the day, it leads to broader security. I would highly recommend it. This is already a common practice, but have time blocks for governance, such that if a governance proposal passes, there is at least a period of 24 hours or so for people to be able to review the consequences before they get enacted, so that there's no malicious person trying to withdraw funds from the protocol, and that can be reviewed more elaborately. And if you see any type of abnormal activity, it's very important to take action as soon as possible. At times, that can prevent exploits from getting worse and depositors to be more safely in general. So in terms of like next steps for the industry, I think in general, we're moving towards a safer DeFi, even though it might not feel so right now. Attack vectors are becoming better understood by all of the protocols and the entities providing capital. So that adds to broader, better security. Automating some of these technical and economic risks so that you're able to, automatically disassemble or automatically pause all protocol activity if there's something abnormal going on. Here again with Interblock, we're hoping that our products help lead us in that way. There's also, with the advent of GPT-4 now, there's increasingly available ways to audit code with AI. So that's something that could potentially bring down the cost of audit and maybe even make every code self-auditable. I'm not super confident in that approach, but at least it should help drive down costs and make auditing easier and more accessible. And also better transparency, making people more educated about these risks. To conclude, DeFi is complex. There's a lot of unique pieces in place, and they all come with their own risks and benefits. Lending protocols are essential for DeFi, but they can be very risky. There's a very high importance to researching all of these risks, ideally in advance prior to deploying, but also monitoring them afterwards. I think especially the economic risks are worth monitoring afterwards, as I mentioned, because it can be mitigated and you can do more about it than technical risks. It's important to understand all the forces at play and set exit plans accordingly. And there's room for improvement, and we hope that in general as an industry we continue to improve and build towards a safer DeFi with less risks. So thanks everyone for tuning in. The next webinar would be about ChatGPT, generative AI, and Web3. Some of the opportunities, challenges, and the road ahead. So of course, this is a very hot topic. We'll have our CEO, Jesus Rodriguez, who's an AI expert and has written about this in CoinDesk and many other publications, talking about that collision between AI and crypto and where that creates some interesting dynamics. So make sure to sign up. Our marketing team just shared the link there to register, and now I'll be sticking around